Alright, for this video series, I wanted to cover a simple example as to how to prepare Schedule K-2 and K-3 with a Form 1065 filing. So this playlist I've broken out into 4 parts, so there's going to be 4 separate videos. So I want to go over high level all the stuff that we're going to cover, and then we'll jump into part 1, which is this video, and again go through those materials, and then at the end we'll go into parts 2, 3, and 4, which again will be separate videos. So what I have in front of us is a slide deck. So we have 5 total slides. We'll go through all those in part 1 here. And then we also have the sample financial statements that we're going to be looking at for the company. So I try to keep this as simple as possible and on just one page. So we've got the balance sheet here on the right hand side, the profit and loss, and then just some additional notes here on the left. And then in addition to that, we have the actual 1065 filing for 2021. And then we'll go through obviously all of the parts that we're familiar with 1065, and then the schedules K2 and K3, which are new for 2021 and going forward. Okay, so if we go back to the slide deck here, again, I want to go through everything we're going to cover, and then we'll jump into part 1 in more detail. So part 1 video, I want to go over some background on K2 and K3 filings, and then cover the fact pattern. And then in part 2, that video will go into more detail in the fact pattern and actually run through the 1065 itself. So we'll look at the 1065, all the pages 1 through 5, any kind of schedules that are required that are going to be consistent with what we've done for years, right? I'm just leaving off the K2 and K3 until videos 3 and 4. Okay, so let's go into some background on K2 and K3 just to cover kind of why the IRS implemented these forms and why they're important to you as a taxpayer. So in my opinion, every partnership filing a 1065 should be doing these schedules, all right? And I'm going to talk about reasons why that's necessary. What the IRS has done is they've carved out some exceptions where you might not have to do it. But as we go through this, you'll learn and kind of pick up on why, again, in my opinion, you should be doing this no matter what. If you have a 1065, you should be completing schedules K2 and K3 for a variety of reasons, but I'll highlight some of the most important ones. Now, what's important to remember here is that these were implemented really directed at partnerships that have foreign activities or foreign partners. But what's also important to note is that a lot of the information that's on these forms has been required for many years. And what I mean by that is that when we look at the different parts and sections of K2, you'll find that a lot of this information, again, like I said, has already been required for many years. The difference is we didn't have an actual IRS form. We had to just add footnotes, which highlighted all this information to the partners. And so then the partners would use that information in the footnotes and use it to complete their tax returns. Now, under the updated 2022 instructions, we have this domestic partnership exception. And again, what the IRS is trying to do here is they're trying to carve out situations where if you have a partnership or if you have an S corp and you fall within a certain unique set of circumstances, you might not have to do schedules K2 and K3. However, a partner or a shareholder can always request that you provide that information. And that's again why I'm stressing that I think that every partnership and S corp should be doing this. They should be completing these schedules in full, but in anticipation of an owner asking for the information. But again, if you find that you're within this domestic partnership exception, you might not have to do the K2 and K3 with your 1065. All right, now, where the partnership only has U.S. partners and U.S. domestic activities. So in other words, all U.S. resident partners, all U.S. source income, no foreign source income, no foreign tax credits. Even in situations where you have partnerships and partners that fall within that realm, in my opinion, again, the K2 and K3 is still necessary because when domestic partners are claiming foreign tax credits from other sources, right, so not this partnership, they need gross amounts of income and expense reported from pass-through entities. So if you take a close look at 1116 or 1118, the 1118 is the foreign tax credit for a U.S. corporation. you'll note on there that in order to properly compute how much foreign tax credit you can take and what the limitations are, you need to know the amounts of gross income and gross expense from all of your partnership investments. So what I mean by that is if we take a close look at a sample K1 from a partnership going to a partner, this is the example K1 we're going to be looking at. Now, if you remember years 2020 and going forward, on line 16 here, we didn't have this simple checkbox. We had line 16 with a number of line items that reported gross income, total gross income by source, tax credits, allocable deductions, etc. Right? And the reason for that is because when we look at things like, let's say line 1 here, line 1 only reports your net allocation of ordinary business income or loss. In no way can we look at this and determine what our gross income is and what our gross expenses are. And that information is very important when a U.S. partner, individual, or a U.S. corporation is trying to calculate their foreign tax credit limitations. And so that's why the K2 and K3, in my opinion, are so great, because what they do is they help these individuals and these corporate entities really figure out what their gross amounts of allocable income and expense are so they can properly complete these forms. Okay. Now, the partner, again, if you find yourself within this domestic partnership exception, you might not have to do K2 and K3, but there is in the instructions a rule that says a partner can ask the partnership to provide this Schedule K3 information, right? There's a 1 month notice rule. And so the partnership, if they get that notice, then they have to prepare this information and provide to the partner. Again, this is why I think that partnerships best served to just go ahead and do this information anyway. It'll provide your partners with everything they need to complete their returns regardless of their circumstances, and so you should just go ahead and do it. Okay, so let's look at the next slide here, which is going to cover the fact pattern itself. So here's the fact pattern we're working with from a structure chart perspective. So what we have here is we have Jane Doe. She is a Bermuda citizen and Bermuda resident, so lives in Bermuda. And then we have John Q, taxpayer, who's a U.S. citizen, and he lives in the Cayman Islands. Now, that's important because, remember, John, as a U.S. citizen, he is always a tax resident of the U.S. no matter where he lives and works. Okay, so very important to remember that. Now, these two individuals decide to form a Delaware LLC. They call it Fake Holdco LLC. They each own 50% of the membership units. This entity, in turn, then opens a Cayman Islands company. So Fake Store Limited, it's a Cayman Islands limited company, which is treated as a corporation under U.S. federal tax law. And this is the legal entity down here that's going to operate a convenience store in the Cayman Islands. All right, so John lives there and works there. He decides that he's going to open a shop there, but he needs a business partner. So he and Jane team up here, and this is how they structure the investment. All right. Now, the Cayman Islands entity down here, 100% owned by the Delaware LLC, which is taxed as a partnership for federal tax purposes. This entity files an election to be treated as a disregarded entity for U.S. tax purposes. That is really important. And the reason why that's important is because that changes the tax reporting for the entity up here. So the Delaware LLC is going to file a 1065 partnership return, and it is going to consolidate all the activities of the disregarded entity underneath because it's a disregarded entity. If they left this entity as is and did not make an election, this would be a controlled foreign corporation. So we would still have a 1065 filing up here, but instead we would have an additional 5471 filing for the Cayman Islands entity down here because it's owned 100% by a U.S. domestic partnership. All right. Now, neither of these entities is considered engaged in U.S. trade or business. There is no U.S. source effectively connected income. Again, that is very, very important to remember because what that tells us is that even though these entities aren't subject to tax directly, we still have to file tax returns because we have a U.S. partnership here. And the allocation of income to John is going to be subject to taxes, not necessarily because this is a U.S. business, but because he is a U.S. tax resident. Jane, on the other hand, will not pay any U.S. taxes. because she is a non-resident of the U.S., and all of these business activities are conducted outside of the U.S., so there's no U.S. tax liability. All right, so let's move on to the next slide here and keep on going. Now here's some more details on the partnership LLC, what we've got in front of us here. So again, just to kind of recap, the holding company is a Delaware LLC. It was formed in March 2021 and has 2 owners. John's a U.S. citizen. He lives in Cayman. Jane is a Bermuda citizen and lives in Bermuda. John is an individual, so he's taxed as an individual, so he's filing a 1040, and he does not plan to make a Section 962 election. Now, what is that high level? A U.S. individual can make an election under Section 962 to be taxed as a C corporation. And that is often relevant when we have interest flowing through from foreign corporations, foreign disregarded entities. In our case, John has already told us that he does not plan to do that. And so for that reason, we can kind of omit certain parts and sections that would otherwise be required in the Schedule K-2 and K-3. Now, the company in the Caymans, Fake Store Limited, again, it's a convenience store, so it's selling everything that you would typically see in a convenience store. The Delaware company, the LLC, is exclusively serving as a holding company. So it holds the shares in that Fake Store Limited in the Cayman. It doesn't do anything else in the U.S. Again, very, very important for analyzing whether we have any U.S. trade or business. And so the Delaware company and the Cayman company do keep separate books and records, right? So the Cayman company has its own accounting records because it needs to report certain things to the Cayman authorities, even though it doesn't pay any tax there. And the Delaware company keeps its own separate records. But when filing the 1065, all of these activities are consolidated. And that's what we'll look at when we prepare the return, is a consolidated set of financial statements at the parent company level. Now, again, because this is a business, neither at the LLC level nor the Cayman Limited Company level are we engaged in a U.S. trade or business. We have no U.S. ECI. And so all the income that's going to be flowing through to Jane as a Bermuda resident, she is not paying any U.S. taxes on these earnings. And that's fine. Just because we have a U.S. entity, if it's a partnership entity, doesn't mean that it's paying U.S. tax, right? We need to assess, is there any U.S. source income flowing through? Is there any U.S. trade or business risk? And in this case, there will not be. Now, again, because the company is a U.S. domestic partnership, it's a U.S. LLC, it still has to file a 1065. So even in cases where we had no U.S. persons or no U.S. trade or business, if you have a domestic entity, you have to file a 1065. And so I have other videos covering that. I'll put a link to those below in the description if you want to check those out. Okay, so let's move on to the last slide here, and then we'll start jumping into the good stuff, the actual return and the financial statements. So what I've done here is I've summarized the parts in K2 and K3 that we'll be completing and why they're relevant. And then I've also highlighted the parts that we're leaving blank because they do not apply given our circumstances. Now, the reason I want to do this is show you that K2 and K3 have a lot of different parts, right? There's a lot of different sections within those parts, but not every single one of them is going to be required. It really depends upon your facts and circumstances. So given the fact pattern that we have, we're going to need to complete parts 1, 2, and 10 on the K2 and K3, and then these are the parts that are left off. So part 1, this is the part on page 1 close to the top where it's just a bunch of check boxes. This is a section where we indicate whether or not there are other elements that apply and we attach additional information. So we are doing part 1, and then part 2 covers foreign tax credit information. Now in the Cayman Islands, we don't have any taxes, but again, remember I highlighted this on the second slide. When we have U.S. persons that are potentially claiming foreign tax credits, maybe from other sources, they need to know their gross income allocations and expense based on source. And that helps them compute their credit limitations. So we're having to do part 2, not just for John's benefit as the U.S. person, but Jane needs to know that as well. This will help kind of bolster the information that's reported in part 10, which is the character of income and deductions for the foreign partners. So this is really, really important. Part 10 is where we lay out to the IRS what income information flowing through the entity is effectively connected income, which would be subject to tax at source when allocated to a foreign partner, versus what is non-effectively connected income. All right, and so we'll see that when we get into the details on Part 10. I'll show you how all those pieces work. Now, here are the parts that did not make the cut given our facts and circumstances, and I want to briefly talk about each one and show you why we're crossing it off the list. Okay, so the first part that didn't make the cut here is Part 3, Sections 3 and 4. Right, so Part 3, Section 3, FDII, so Foreign Derived Intangible Income. This applies when we have income allocated to U.S. corporate partners. And in effect, what happens is corporate partners get a favorable tax deduction for activities that are conducted overseas. So if you sell products or services by a U.S. corporation to foreign persons, you get a tax break for that. Now, here's the problem, right? We don't have any corporate partners, right? We look at our cap table here. We've got John and Jane. They're individuals, so they're not corporations. And again, remember, John has affirmatively said he doesn't want to be taxed as a corporation, so he's not making a 962 election, so it's kind of a moot issue here. The other point is FB, so foreign branch income generally doesn't qualify for FDII. So across the board, this is just one of those things where it just doesn't make any sense for us to do it, and so that's why we're leaving Section 3 off. Same thing goes with Part 3, Section 4, right? So Part 3, Section 4 covers foreign taxes paid under these circumstances. We're in the Cayman Islands, right? So we have a Cayman Islands-based foreign branch. Cayman Islands doesn't impose any income taxes on corporations, so that's going to just be zeros. No need for us to complete it. All right, the next part that we're leaving off here, Part 4, again, additional information on Foreign Derived Intangible Income, FDII. Doesn't include foreign branch income, so we're leaving this blank. So Part 3 and Part 4, totally blank because we've got foreign branches here, no FDII and no corporate partners, so across the board, not an issue for us. Part 5. Part 5 is distributions of cash or property from that foreign corporation to a partnership. Couple of issues here, right? The first one to consider is the Cayman Islands entity has elected to be a disregarded entity. So it's not a CFC, it's not a PFIC, nor is it a foreign corporation that is still treated as a foreign corporation. It just doesn't meet, let's say, a CFC or PFIC rule. So we don't have any of those issues here, nor do we have any distributions for the period. So if we briefly look at the financial statements here, and of course I'll go into these more detail, but if we look at the equity section for the company, we've contributed capital to the company, but there have been no dividend distributions. So no distributions from the Cayman Islands entity up to the LLC, nor from the LLC to the partners. And so that's why none of that information is being reported. All right. Now, Part 6, Subpart F and guilty inclusions. So Part 6 would include Subpart F and guilty if we had a controlled foreign corporation, right? So a CFC filing a 5471. In our case here, we have a wholly owned entity that elected to be a disregarded entity. So we do not have a CFC. We don't have 5471s. We will have an 8858, right? So for a foreign branch or foreign DRE, but we don't have any 5471s. And so we don't have any Subpart F or guilty inclusions, right? So everything that's going on in this Cayman entity is deemed to pass up to the U.S. LLC because it's all being consolidated, right? Okay, so Part 7, PFIC investments. So Part 7, we would list any kind of PFIC investments that the partnership had during the year. And then there's a variety of columns and other kind of check boxes for certain elections that might have been made. In our case, we don't have any PFICs, right? So our U.S. LLC only has an interest in one foreign corporation, and the foreign corporation decided to make a disregarded entity election, so we don't have a PFIC, okay? Now, Part 8, partnerships interest in foreign corporation with deemed paid foreign tax credits. So when would this arise? if a partnership has an interest in a foreign corp, so let's say there's a 5471 filing and there's some subpart F income or GILTI, the partnership can pass on that income to its corporate partners, and the corporate partners are allowed to take a deemed paid foreign tax credit for the amounts paid at that foreign corp level, right? So this is referred to, well, part of it is what's called the Section 78 gross up. So you're allowed to gross up the amount of your subpart F income because you're going to take a foreign tax credit for what was paid at the foreign corporate level. In our case, again, we have no corporate partners. Our individual partner, John, is not making a Section 962 election. And we're in Cayman, right? We don't have any foreign corporate taxes, so no corporate taxes paid at this level. So Part 9, the BEAT, or Base Erosion Anti-Abuse Tax in Section 59 Cap A. So this helps to combat kind of, reducing your corporate tax base by funneling money offshore, let's say. So the BEAT, so Section 59 Cap A, this really only applies where we have related party transactions between the U.S. person or the affected taxpayer and then their offshore affiliates. It also applies only to corporate partners with a lot of money, right? So if you look at Section 59A, the definition of applicable taxpayer is a corporate partner that has over $500 million in gross receipts, right? So this 59 Cap A was put in place to really target those big mega companies. That is not us. That is not our fact pattern. Okay, so that's why we're leaving Part 9 blank. Okay, so now if we move over to Part 11 here, we have Section 871M for covered partnerships. Okay, so covered partnerships. 871M was put in place because very creative tax planners and financial products specialists were coming up ways to create dividend equivalent payments to avoid withholding. So you have an 871 partnership if you have foreign investors that are receiving funds that find themselves dipping into this realm of dividend equivalent payments, derivatives, things like that. If you have a partnership set up like that, you'll kind of know it when you see it. Otherwise, this is really not applicable to you, and certainly not applicable in our case. We have nothing creative here from a U.S. equity or derivative payment plan type of payment arrangement. Part 12 is blank, right? So this is set in as a quote reserved for future use. So it's on the Schedule K-2 and K-3, but it is blank because it's reserved for future use. And then the very last one here only applies to Schedule 3, Part 13. This is, so you wouldn't see this directly on Schedule K-2, and the reason for that is Schedule K-3 Part 13 only applies to information on a per partner basis. So if a partner redeems out or sells their units, there might be some gain recognition based on the underlying assets of the company. So for example, if you have a partnership, a PTP is a good example. You have underlying hot assets under Section 751. So those are inventory or unrealized receivables. If you have a sale of those hot assets, the ordinary gain is recognized at each partner's level. And so the reason why this is unique to each partner is because the partners that are still in the partnership don't have this issue, right? It's only the partners that would sell their units or redeem out that might have this problem. And so that's why we won't see a Part 13 on Schedule 2, but if it is applicable to the partnership, it does have to be added to Schedule K-3, Part 13, for those unique partners, right? The ones that are redeeming out or selling their units. Okay, so that covers the high-level background, what we'll get into. Let's jump over to Part 2. This is the next video where we're going to cover the fact pattern again, look at the financial statements, and then actually review the 1065 itself before we really dive into the Schedule K-2 and K-3.